Hey YouTube, my name is Jake and welcome to my channel. In this video, I want to share a quick way to analyze a company's financial statements by using the ratio analysis method. So, why is this important for investors to analyze a company's financials? Since the stock market in the short term is highly based on emotion, not fundamental of the company, it is helpful to learn how to control your emotion as well as understanding the temperature of the emotion of the market to be successful as an investor. However, in the long term, this emotion tends to follow the company's current earnings or future earnings expectations, which is the company's financial performance. The stock market is not a lottery ticket. There are real companies behind it, and no one wants to invest in a company that can't make money. Therefore, obviously, investors must buy the stock at a cheap or fair price and sell it at a much higher price than when it was purchased. So, to do this, investors must know how to read financial statements such as income statement, balance sheet, and cash flow statement and analyze a company's financials, because understanding the company's financials will not only help you to control your emotions since you're thinking with logic, not emotion. This will help you as an investor to make a better decision when the market is not aligned with this value. There are many ways to value a company, such as discount cash flow method, one of Warren Buffett's favorite way to value the company. But in this video, I will show you how to analyze a company by using the ratio analysis method for each different financial statements. Income statement. So what is the income statement? An income statement is basically to show overall profits and losses, such as the company's revenues, expenses, and net income, to see if the company has made money or not. First, gross margin ratio equals gross profit divided by revenue. Gross margin ratio shows the basic profit margin of the business is generating from selling its goods or services. Operating margin ratio equals to operating income divided by revenue. It shows the operating profit margin on the company's effectiveness on controlling its expenses that are related to its business operation. Net income margin ratio equals to net income divided by revenue, and it shows the percentage of the profit when a company sells its goods or services. Debt ratio. Interest coverage ratio equals EBIT or EBITDA divided by interest expenses. You can either use EBIT, earnings before interest and taxes, or EBITDA, earnings before interest, taxes, and amortization. For this equation, it doesn't really matter. And it shows the company's ability to service its debt based on its current available earnings. This ratio is very important because higher the number, the company is in healthier financial position to pay its debt, and low number indicates that the company doesn't have enough profit to cover its debt. However, if the ratio is too high, it could also mean that the company is not good at using its debt to grow the business. Using leverage is very important to grow the business because you can never really grow your business with your own money. You should always use other people's money. Now that we covered the equations, let's analyze one of the most popular stock on NASDAQ, Amazon's income statement, using the 4 different ratios we just went over. You can get the financial statement data from either Yahoo Finance, Morningstar, Seeking Alpha, or you can use your own stock brokerage account website. So this is what it looks like when you copy the data and organize the data into an Excel sheet. Before we go into calculating the ratios, first you should always be checking if the revenue has been consistently growing with the net income as well as the overall expenses are declining. However, early startup companies will be obviously different because their primary focus will be growth. So as you can see, Amazon has consistently growing its revenue every year by 27% on average. This is very impressive number since it is almost growing at about 30% compounded annually. Also, expenses has been growing at a rapid pace. However, looking at the research development and selling general and admin, Both are growing, especially research development. Just by looking at the number, it seems like Amazon is not good at converting its revenue into profit. However, Amazon is well known for focusing on the long-term growth by heavily investing all of its profits right back into the business. To know more in detail, you should always be reading the 10K form before you analyze the financials. Overall, net income has been also growing significantly, especially in 2018. This is due to AWS growth. The gross profit margin for Amazon is about 25% on average, and this is Amazon's basic profit margin when the company sells its goods or services to its customers. The operating margin is 4% on average, meaning that every dollar Amazon earns in revenue, it brings about 4 cents in profit. This number could seem low, but it depends on the industry average and the nature of its business. Amazon has been expanding its business in many different areas such as AWS Cloud, Prime Video, streaming Twitch, and investing heavily into autonomous vehicle and logistics recently. So I would expect this number to be low since they are very active on research and development to grow their businesses. Net income margin on average, it shows 3%. Again, since Amazon heavily focuses on growth, Amazon reinvests all of its profits back into business to grow even more for the future. This positive expectations will impact the movement of the stock prices later down the road. Interest coverage ratio shows that Amazon can cover about 21 times its current interest payments with its available current earnings on average. Here are some things to consider when you're going through the company's financials. Always check to ensure that the revenue has been consistently growing with the net income as well as the overall expenses are declining. If the revenue and net incomes are growing into opposite direction, this can be a bad sign and you should dig in further because this is a common way for companies to manipulate its financial position to make it look more attractive. Compare the ratio results with the industry average or with a similar company because you don't want to compare Amazon with other industry because their industry standard and nature of their business, investors will have different expectations. Lastly, does the numbers make sense to you? If it doesn't, chances are you don't really understand the company's business. This is why you should always read the 10K form first or research on the internet to make sure you have at least enough basic or minimum industry knowledge. In this video, we cover basic ways to analyze the company's income statement by using 4 different ratio equations. In the next video, I will show you how to analyze a balance sheet with other ratio equations. I hope that this video was helpful for you to understand and start getting into analyzing the company's financial statements on your own because only you can control your investment and your financial freedom. If you like this kind of video, please give it a like and subscribe so you won't miss the part 2 and to see more videos like this. Thank you for watching.